Well, it gives me great pleasure now to welcome on board Neelkanth Mishra, Chief Economist, Axis Bank, and Head of Global Research with Axis Capital. In fact, it's for the first time we are interacting with him in his new avatar. So nice to have him back. I've always maintained that his ability to spot the mega trend, throw in the macro aspect, talk about valuations, and then throw in that extra dimension of micro is quite extraordinary. So this is one interview I always look forward to learn, understand, and to decipher the big trends. So nice to have you back on Mr. Mishra. How's the new innings?
Pleasure to be back. Thank you for having me.
How has life changed for you?
Oh, it's busier than ever. There are a lot more ideas that I can now explore compared to what I used to do in my earlier avatar. So very exciting times.
So let's take a deep dive. First, what is your understanding of the world? US looks like has averted a recession. China has not come back on expected lines, and Indian markets and Indian economy is getting more and more glorified in terms of both global opinion and also in terms of trajectory. How would you connect the big picture first for us?
So let's take one layer of the observations you made, which as usual are quite on the spot, on the dot. So the reason why the US recession has not occurred yet is because of a significant expansion in the US fiscal deficit. So they're effectively adding $1 trillion of debt every month. I think most people who expected that hike in interest rates would drive a US recession had not anticipated that their annualized fiscal deficit would be upwards of 8% of GDP in this year. Now, that itself has its own ramifications. So the risk-free rate for the world, which is the 10-year US bond, the yield on the 10-year US bond, is now at 4.37. And in fact, what we have been researching and flagging is that a lot of this 2% point increase in the 10-year bond yield in the US, which is the risk-free rate for the world, is something that is going to last for a while. It is very difficult for that rate to come down. One very simple observation to support that is that one of the reasons the US fiscal deficit is so high is that their tax collections are not good enough. And so this means that some of the valuations that the markets have been used to, and in the 10 years preceding COVID, where the US mostly had a tight fiscal, loose monetary stance, and now they seem to have a tight monetary, loose fiscal stance, will mean that the PE multiples that we are used to will not apply. The muscle memory of the market will be tested. On the China side, if you unpeel one layer, the market has actually started feeling a bit more comfortable given the last month's data and the last couple of weeks. We are seeing some recovery in demand. Even the August retail sales did slightly better than expected. The underlying trend is still very worrying, which is that they have to go back to the old strategy of triggering more or supporting real estate construction, more infrastructure construction, whereas that only worsens the medium and long term. So the medium-term outlook for the world economy actually does not look very promising. And I think there should be in the next maybe 12 months. It is not immediate. Let me say that some of the risks we are talking about will likely play out over 12, 24 months and not 3 to 6 months. But these are things that we have to keep at the back of our mind.
Okay, so it will have two implications, economic implications and implications for the financial market. And we've always debated in the past that what happens to the financial market sometimes in the short to medium term could be independent of the real economy. If your view is that next 12 to 18 months may not be all that sanguine for global global economies, what does that mean for India and what does that mean for Indian financial markets?
So as much as we would like, we are not an island, and our interconnections to the world are much deeper than they were, say, 30 years back, 20 years back. So incrementally, we are getting more and more connected to the rest of the world. And therefore, there will be risks. There are risks on Are services exports slowing down in the near term? Medium term, I'm very positive, and I think it's going to be a great growth story, a great growth driver over the next 3 to 5 years. But in the near term, I think there are risks to that. There is already visible risk. We are seeing goods exports slow down. There is a very meaningful risk of the Chinese imports, or I would say the global goods oversupply that results from firms having overinvested because of the price surge that we saw in 2021 and 22 into capacities. And now the global goods demand is running well below trend. And that means that there's an oversupply of goods in the world, and therefore India's manufacturing competitiveness will be tested. And that will mean that we could see more and more imports starting to happen. And it would be unclear, at least for several months, if not quarters, whether this requires import protection or duty protection. So those are the risks that I think we need to be wary of. What may happen, maybe when the loan rollovers in the US start really accelerating, which is maybe following second quarter in 2024, which is June quarter 2024. It's only after that I think the risk of failed loan rollovers starts to become meaningful. Around that time, I think the risk premium in the market. So right now, volatility in the bond market, volatility in the equity markets is at very low levels. And therefore, people are speculating quite freely. But those are things that we have to keep in the back of our minds.
Mr. Mishra, just when it appeared that world is getting a handle on inflation, despite demand from China, crude is up. Olive oil prices, I was reading in the morning, up 100%. Edible oil prices have gone up. Copper prices have gone up. So if demand is getting constrained more and more, what explains this asset price inflation?
So the commodity price inflation is the edible oil. Clearly, I mean, if El Nino is as bad as the rains in India seem to show, then it is going to hurt the plantations in Malaysia and Indonesia as well. In crude oil, you must have seen that the strategic reserves in the US are now at 30-year lows, and someone seems to have woken up. There has been a restocking of the strategic petroleum reserves in the US. And then copper, it's about China going back into, even if temporarily, into that old mode that, so they know that they cannot keep reinvesting in real estate. They cannot keep building infrastructure, which can become a bigger problem incrementally in the next couple of years. But at the same time, if they don't do that, the economy starts to struggle. So they are currently in that mode. And then plus, of course, the fact that the battery market in the world is seeing a lot of industrial policy intervention. So every country, in fact, Axis Capital recently put out a deep dive into how much subsidy is being thrown into batteries by the US, by China. And what that means is that the EV market will do better than was expected, say, even 1 year back. And which means, stronger demand for everything related to EVs and renewable energy. And therefore, demand for copper also starts to get boosted.
I'd like to draw your attention to what, in a sense, is the biggest global narrative, and that is China plus one. Manufacturing seems to be moving away from China for strategic reasons and because of political reasons. Indian markets and Indian economy have benefited from that. Do you think this is real and this is a trend in making for next couple of years?
It is definitely real, and it has to play out over the next couple of years. I think it is important for us not to be impatient when we are looking at the results of this. So if you look at the numbers, the Chinese goods exports, so Chinese share of global goods exports has actually gone up in the last 2-3 years. So what you're seeing is, even if you measure, say, the share of US imports coming from China, that has dropped off very sharply. But it's just crossing the border into Vietnam. And so a lot of the export value add is still happening in China. See, these are supply chains which are very hard to shift, and the shift is going to be a very slow process. Is India benefiting from it? I think it is. We are seeing, for example, smartphone exports, which were from India, which were 45,000 crores in FY22, were supposed to be 75,000 crores in FY23. They turned out to be 89,000 crores. This year's target expectation was 140,000. It is possibly going to reach that very easily. So the growth is very substantial in a market, in a global smartphone market, which is actually slowing. So it has gone from 1.6 billion units to 1.2 billion units. And this is a clear example of China plus one. There are some other sectors where this is happening. I think a lot more can happen if we can improve our ability to give comfort to multinationals, global multinationals, that India has regulatory certainty and we can give them that certainty much faster. So just for perspective, in 2005, about 18 years back, 58% of Chinese goods exports were from multinationals using China as a manufacturing base. So it was not for Chinese demand, it was just Chinese foreign firms using China as an export hub. Even today, 31% of Chinese goods exports are by multinationals operating in China, more than $1 trillion. If India has to take that share very quickly, at least for the next 3 to 5 years, I think we have to focus on foreign firms using India as a manufacturing base. And for that to happen, we need to speed up the pace at which we sign advance pricing agreements. We need to speed up the pace at which we provide clearances on land, on labor, and so on and so forth. And this is a great opportunity over the next 1 or 2 years. And if we can speed that up, then I think we will be, over the medium term, much bigger beneficiaries of the China plus one trend.
CapEx, something which we've discussed over the years with you, seems to be focused around infra development. Road has been a resounding success. Now it's tilting towards defense and railways. And while the shift is happening, stock markets, when I say stock market, equity markets have been mighty excited. We both are aware of the rally what defense stocks and railway stocks and shipbuilding stocks have seen. What is the right way of understanding these government commitments towards shipbuilding, road, defense, railways? And if you could connect the equity market outlook also for us.
So the central government, these are the sectors that it has not a monopoly on, but it can control directly. And therefore, national highways, railways, so these are central subjects. Defense these are central subjects, and this is where the central government can play a big role. On the road side, I think the pace of construction is unlikely to, it's unreasonable to expect that if you're already doing 16,000 kilometers a year, that you will be able to do much more than, say, 20,000 kilometers a year. So incremental growth in terms of the pace of construction at a national highway level may not really accelerate from here. What can happen, and is likely to, and it seems to be happening, is that state highways, so there are lots of work happening in Maharashtra, in Uttar Pradesh, in several states where state highway construction is also accelerating. So that's where perhaps there can be some acceleration. But, if you have a 2 lakh kilometers of national highway network and you are repairing everything once every 10 years, it is very hard to envisage, unless you are doing a lot of fresh alignments, a big expansion beyond 20,000 kilometers a year. On the railway side, I think the scope to do work is quite significant. Railway as a share of freight, the railway share of freight had been falling since independence. I think the last 2 years that number has started to inch up, and it has to rise substantially from where we are now. And that requires, I think, a steady pace of investment, and not just on the freight side. I think there is enough investment that is necessary on the passenger side to improve the quality of travel, the comfort level, and all that. And the problem so far has been that the railways they struggle to invest. So the availability of fiscal resources is not the constraint, it's their ability to execute. But very hearteningly, we have seen in the last 2 years that there is a pace, pick up in that pace as well. On defense, I think it's a medium-term opportunity, meaning that we know that there is going to be more focus on Atmanirbharta, that is more self-dependence. Globally, spending on defense is starting to go up. And when we think about defense, we have to think beyond just the final assembly of submarines or the final assembly of planes. It has to be the whole ecosystem. Special types of casting, special types of forging, special types of materials, software, electronics. So there's a lot of stuff that goes into defense procurement. I think what we are seeing in the markets is that people do this top-down macro investing, and they say, okay, so I think defense is going to do very well, and therefore let's go and buy the few stocks that exist. Now, I think what is starting to happen, there are many of these stocks won't cover, and I don't think it's appropriate for me to talk on specific names. But as a theme, I'm observing that because everyone wants to invest in defense, everyone wants to invest in railways, there is a very steady rise in price to earnings multiples without an appropriate visibility on what's happening to their own order books. Will they be able to participate in this? Will they be able to compete in this? So even on, say, something like electronics, I think there is a very good probability that India's electronics ecosystem will continue to grow. There will be a higher share of value add in 5-7 years. There will be lots of new activity and fascinating activity that comes up. But does that mean that every electronics company needs to trade at 45-50 times earnings? Given that their share of value add is low, they will have to take a lot of business risk. And those are questions that I think the markets are not asking appropriately. And there is, I think, in many of these names, quite a bit of froth.
One amongst the few who called out the COVID recovery right in terms of the shape. You said it would be a divided recovery, and I think now it's visible. It's a K-shaped recovery. Rural under stress, urban and ultra-luxury doing exceedingly well. Now, given that if economy has to grow at 6.5 to 7%, it needs a full participation. How long this divided picture could last? It's more like a fractured economy right now we are staring at.
I think that picture is a bit different from the way you characterized it right now. While that may have been the case, and that was the case about maybe 6-8 months back, I think that system is shifting. And I think on your show as well, we have discussed this in the past. When you have an economy forced into a lockdown and consumption of services slows down and construction slows down, you see a drop in the number of jobs that in that pay, the 8,000 to 15,000 rupees a month. And so when you come out of the lockdown, as the restrictions are eased, there are savings among the rich and deficits among the poor, because the poor had to still survive, still pay for food and basic clothing and basic telecom, etc., etc. And therefore, they had to shed assets or take on debt, and there was a lot of saving here. Now, as the rich then start to spend on travel, on tourism, on eating out, on coaching, on or construction, the savings start to flow, and the economy then starts to become more balanced. And we are seeing that, right? So if the biggest takeaway from the June quarter results, and I think that has continued into the September quarter results as well, September quarter business momentum as well, the evidence that even the independent home builder has now come back and is starting to construct is very clearly visible in the demand for cement, the demand for tiles, the demand for PVC pipes, the demand for cables and wires. And that, if all of that demand is going up, that means that construction activity is also going up, right? No one is just going to buy these and stock up, right? And construction jobs are exactly in that bracket. You're seeing a sharp recovery in travel and tourism. And therefore, the bottom end of the K that you were talking about is starting to lift up. Now, one important overlay we must put on that is what's happening to the commodity prices and food prices and so on and so forth, right? So for example, if India is buying oil at $20 a barrel higher, and it was, I mean, when oil prices went say 80 to 100, you're talking about a $30 billion hit to the economy on an annual basis. And a reasonable part of that starts to flow through to the poor, through the plastics, the packaging. There was a big surge in global sugar and wheat and edible oil prices. And as those have corrected, now, of course, we are seeing an early part of the increase, and we need to be very cautious about, therefore, extrapolating on the decline. But at least so far, right, before this recent hike happened, there was clearly a drop in prices. You look at biscuit demand, there was stories over the weekend. Biscuit demand is rising like 15-20% because biscuit prices have started to normalize. So I think the demand conditions are...
That's the most interesting conversation with Neelkanth Mishra, the snippets of which you can catch throughout the day only on ET Now.